In this presentation, we're going to continue on with our corporation comprehensive problem recording revenue on account. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Our information is going to be up here on the left. We're going to enter that into our general journal, create and post to the general ledger, creating the trial balance from it. We're going to perform work on account and earn revenue. So first question I would ask is always, is cash affected? In this case, we're going to say it's not because we did work on account. That would be really clear if we were in business because we would know exactly what we do and how we bill people. So if we do work, if we're in the type of industry, if we do something like construction or something, or bookkeeping or something like that, and we do work before we bill the client, then we would know that we would bill the client, invoice the client, after we have completed the work. That's in essence what's happening here. If we look at a book problem, however, it's going to have to be indicated in some way that we did work and we're going to get paid. There's 3 times periods we can get paid relative to doing work. Either we got paid before we did the work, we got paid at the same time we did the work, or we're getting paid after we do the work. In this case, we're doing work and we're going to get paid later, which is going to be a typical for many types of industries, many typical business models. So that's going to be indicated by on account. On account is going to mean that we didn't get cash at that point in time, in this case, or it's going to mean later that we're going to get cash for work that was done in the past. So we'll see that later. So is cash affected? No. Then I would think about what we got. And what we got is a little bit more confusing. We got an IOU. We have people owing us money. We did something. We have an agreement. We have a type of contract, even if it may be only verbal. And we've completed our portion of it, and therefore are due money in the future. And that's an IOU, that's a promise to pay, that's kind of like that's a receivable. Similar to a notes receivable, but we're going to put it in accounts receivable, something that's going to be due in a shorter time period. So usually less formal, shorter time period that it will be due in. It, like cash, is an asset. It's going to be one of our favorite type of accounts, or second favorite account. We'd rather have the money, but we're hoping this is going to turn into money within like 30 days. So it has a debit balance. People owe us more money, therefore it needs to go up. In order to make things go up, we do the same thing to it, another debit. So we're going to put the date, we're going to put the account, it's going to be a debit, 12,000. Then the credit's going to be 12,000. We know what the credit amount is. Where's it going to go? The credit is going to go to revenue. We earned revenue. And note that some people might get this mixed up and try to get cash in there somewhere and say, well, we need to be dealing with cash because we'll tend to link the concept of cash and revenue, but they're different. Revenue is telling us that we have earned money, whereas cash is a form of payment. In this case, we earned money and we still have something in terms of an asset. We have an IOU. It's not as valuable as the cash, but it's just cash is just one form of payment. We're recording the revenue at the point in time that we earned it, when we did the work in accordance with the accrual principle, in accordance with the accrual principle of revenue recognition. Now, we may not recognize that revenue is always a credit balance because we may not see or work with revenue as often as we do with, say, cash and other assets. So oftentimes we'll learn that cash is a debit balance. It goes up with a debit because it's the same thing as what it is, and down with a credit. And therefore, it's easier to think about cash or an asset oftentimes and then figure out what the other account is doing. And then we think of revenue and say, well, revenue, if you think about it, it only has a credit balance. On the income statement, it's kind of like revenue. Our credits are good and debits are bad. On the balance sheet, or at least on the first two part, we like debits because we like assets, and we don't like credits much because we don't like liabilities. And that kind of falls apart in the equity section because as owners, we like the credit balance of equity. But if you think about the business being separate from the owners, this represents that the business owes somebody, owes the owners. On the income statement, we think of it's kind of reversed, meaning the credit balances are good. We like revenue, and we don't like expenses because revenue makes net income go up and expenses make it go down. So in any case, revenue is going up in the credit direction. It only goes up in the credit direction unless something unusual happens. So we're always going to be crediting revenue, always going to be doing the same thing to whatever the normal balance is of these temporary accounts, of these income statement accounts. So now we'll post this to the general ledger. So here's just an outline of the entire general ledger as we have so far. It is in order. Remember, it's in order here: assets, liabilities, equity, income, and expense. We're looking for receivables and revenue. So if we go through here, receivables is an asset. It's our second asset here, just as it was in the trial balance. Revenue is all the way over here on the income statement. Same order as it was on the trial balance: assets, liabilities, equity, and then revenue and expenses. It's our first income statement account. We're going to then zero down on those two accounts and post our journal entry. So here's the accounts receivable. We're going to post that here. Here's the accounts receivable. It had a zero balance. It's going to go up by $12,000 to $12,000 in the debit direction. Revenue, we're going to have a credit. Here's our credit GL account. We're going to post this. This is the process of posting. We're posting from the general journal to the general ledger. So we've got the credit of $12,000. It's always going to be a credit to revenue. Revenue only goes up in the credit direction to $12,000. If we use these then to construct our trial balance, as I recommend doing each time, we only have to change those two accounts. So if we go to our trial balance, we're going to say, okay, the receivable has now changed by that $12,000, and the income statement, or the income, revenue or income, has gone up by this $12,000. All the other accounts are being constructed from the GL as well, but they haven't changed. Those are all the same as they were from the prior transaction. So we can see how we're building this here now. Now the assets went increased, and we increased equity in a way. We increased revenue. So if we see this in terms of the journal entry, what happened here? Well, the accounts receivable went up by this $12,000, and we see that the revenue went up by the $12,000. So what does that mean in terms of our accounting equation? Assets went up, the green accounts went up, nothing happened to liabilities, they stay the same. And remember that this entire thing is equity. So the whole income statement is part of the equity section. It's basically a detail information breaking out some of the information of the equity section, the accounting equation being something that's as of a point in time balance sheet. This then breaking out some of that in terms of time period, timing accounts, income statement accounts. So that means that this is going up. So we increased equity. We can see that net income is increasing as well, because net income is revenue minus expenses. So this is a credit. Revenue went up in the credit direction. So the credits are beating the debits. This net income is taking this account, the credits, minus all the debits. There are none yet, and therefore we are in balance. This green zero means that the debits minus the credits are in balance, meaning the debits are represented with non-bracketed or positive. The credits are bracketed, and if we subtract out the debits minus the credits, they will equal zero. This is a way to give us a really quick check that this equals zero, and a way to give us a really quick calculation of net income by just taking the credits minus the debits. And it works really well if we're using software like Excel for us to format in this way. So I highly recommend, if you're working with certain types of software, or if you work in Excel, this will make your work a lot more efficient if you can learn that this zero represents debits minus the credits and start formatting things in such a way that you can make things as efficient as possible. Save space, simplifies formulas. For more accounting information and accounting courses, visit our website at accountinginstruction.info.